Trends is what you always want to keep up with, especially if you want to be conversant about the world around you. This is also of utmost for traders who trade in the Forex market. Though we always say a trend is your Forex. We welcome you to the Financial Market Examiner YouTube channel, where you learn about Forex, cryptocurrency, and the stock markets. In this channel today, we'll learn about how to trade the trends. If you're a beginner, kindly see our video on what is Forex. Let's get right to the business of the day. You need to get your writing materials as you learn more about Forex in simple terms. What is a trend? A trend is a term for when a given market is moving in one direction overall. There are three directions in which a market can move: upward, downward, and sideways. Whatever your chosen style, learning how to identify and classify trends as a form can go a long way to trading successfully. There are three main types of trends. 1. A major or primary trend describes the dominant direction of a market movement over a long period from several months to several years. 2. Intermediate or secondary trends. This occurs within major ones when a market moves in a certain direction over a shorter time. 3. A minor trend will appear over a short period, often less than 1 day. For example, a market that has rallied significantly over the past 18 months is a major uptrend. However, within that bull run, the market may become range-bound for several weeks or months before resuming the rally. This will create an intermediate trend. And on any given day, a minor bull or bear run may form. How to trade with trends? The type of trend you look to trade will depend on your chosen strategy. Long-term investors, such as position traders, look for primary trends. That way, they can capture larger moves to earn the large profits required by their plan. Medium-term traders, such as swing traders, may seek to capture secondary trends, lasting from days to weeks. Day traders and scalpers, on the other hand, will only pay attention to minor trends. Whatever your approach to the market, the difference between success and failure will often depend on how well you can time your trends. If you can open positions as a form, then close before the reverse, then you'll soon see your profit margins grow. Tools for trend trading. Technical analysts have lots of tools at their disposal for identifying and classifying trends. 1. Trend lines. Trend lines are one of the simplest methods of defining bull and bear runs. You apply them to charts, using them to identify the strength and direction of trends. Trend lines help to smooth out the oscillations within a market's price action, enabling you to plot the rough course of any movement. They cut through the noise to show whether there is an underlying bull or bear run. You can spot an uptrend when there are higher highs and lows as time passes. To apply a trend line on a chart that you believe is on a bull run, simply plot a line between 3 or more of the market low points when it has dropped to a low price and reversed. If the line points off, then you have confirmed the uptrend. The steeper the line, the stronger the move. Downtrends, meanwhile, are identified by ever lower highs and lows. To find a downtrend, you draw a line between 3 high points. If it points down, then the market is on a bear run. While you can draw a trend with 2 points, it isn't confirmed unless there are 3. If the lines are horizontal, then the market is range-bound. When a market is sticking to its trend line, then you can use them as areas in which to open new positions, maximizing your profits within a trend. 2. Channels. You can also use trend lines to identify channels. Channels are comprised of 2 parallel lines, with a market's price action bouncing between them. To find the channel, draw 2 trend lines, one between 2 high points on the chart, and one between 2 low points. If the market's price action remains between these 2 lines, then you can trade the channel by selling at the top and buying at the bottom. 3. Pattern. Lots of traders will also use chart patterns to spot trades. When a market is in a trend, then its chart will typically show an ascending or descending staircase pattern. This is when each high or low outpaces the last. However, there are also lots of patterns that technical traders believe can predict whether a trend is about to form or reverse. This can include triangles, flags, and wedges. 4. Volume. One useful tool when looking for trends in volume. Volume tells you how much security has been traded in any given session, and can offer insights onto how strong a move is. If a market is on the up, but barely anyone is buying it, then the move may not have enough momentum to continue for much longer. 5. Indicators. Using indicators can also assist a trader in trading with a trend. A popular indicator used by traders in a moving average. This gives you an average of a market price movement over a given period and can tell you what it is about to enter a new trend. The relative strength index, on the other hand, is often used to measure the strength of ongoing moves. Indicators and patterns can both be useful when looking for trading opportunities, but they aren't foolproof. Correct money management and risk control, as always, is imperative. And if you've heard the word trading trends, then this detailed explanation should have helped you out. Let's have feedback from you about our videos in the comment section. Hope to see you in our next video. You can get more videos on this channel by clicking the subscription button, and don't forget to also like the video. Note that this video is not financial advice, but for educational purposes only. Thanks for watching.